Hello trader and welcome to the ComLucro channel. In today's chapter of our Smart Money Concepts course, we're going to unravel one of the most intriguing concepts in the financial market, buy-side and sell-side liquidity. In this video, you'll learn what buy-side and sell-side liquidity zones are and how to identify them. We'll cover the difference between internal and external liquidity, delve into the psychology behind these liquidity areas, and how they affect market behavior. You'll also understand the importance of these zones for traders and how they can be used to predict price movements. Plus, we'll provide practical examples and techniques to identify these zones on price charts. First, let's define and understand the concept of liquidity zones. These zones are specific areas on the price chart where there is a significant accumulation of buy or sell orders. These zones are created by large institutional players who seek to move the market in their favor by manipulating market sentiment. Correctly identifying these zones can offer a strategic advantage to traders, allowing them to predict price movements with greater accuracy. Within the concept of liquidity zones, there are two main types: internal liquidity and external liquidity. Internal liquidity, also known as fair value gaps, FVG, refers to areas within the current price structure. These gaps occur when there is a significant difference between the closing of one candle and the opening of the next, resulting in a liquidity void. These areas are important because large market players tend to fill these gaps, creating trading opportunities to capture movements back to fair value. External liquidity refers to zones outside the current price structure, located at previous swing highs and lows. These areas are points where retail traders often place their stop-loss orders. For example, at a swing high, many traders might place stop-loss orders just above this level, creating a liquidity area that large players might target to capture these orders before reversing the price. To understand their importance, let's explore how liquidity zones function in the market. First, let's talk about price movement. The price tends to move between internal and external liquidity, and also buy-side liquidity, BSL, and sell-side liquidity, SSL zones, seeking these areas to fill orders and generate volatility. Large financial institutions and experienced traders exploit these zones to execute large volumes of trades without causing significant price fluctuations. By identifying these zones, traders can more accurately predict market movements and adjust their strategies as needed. Now let's look at how we can use these liquidity zones as an analysis map. Liquidity zones can be used as a valuable tool for chart analysis. They help traders identify entry and exit points with greater precision. By mapping these zones on the price chart, traders can visualize where there is a concentration of pending orders and anticipate possible market reactions. This allows for more informed decision-making, increasing the effectiveness of trading strategies. To fully grasp these concepts, we need to delve into the psychology behind liquidity zones. Imagine the price entering an accumulation or distribution phase. During these phases, the price creates equal highs and equal lows before starting the markup or markdown phase. In these phases, we have a support level at the bottom and a resistance level at the top. Retail traders typically look to buy when the price reaches the support level, placing their stop losses just below it. This creates a substantial liquidity pool beneath the support level, consisting of the stop losses of these buyers ready to be triggered by the market. Additionally, it includes sell stops from retail traders who plan to sell if the price breaks below the support level, believing that such a break will initiate the markdown phase. On the buy side, when we encounter a resistance level at the top of the equal highs, many retail traders look to sell as the price reaches this resistance, setting their stop losses above it. We also see buy stop orders from retail traders expecting the price to continue rising if it breaks through the resistance. This scenario creates a well-defined liquidity pool with various types of orders ready to be swept by the market, both above the equal highs and below the equal lows. To illustrate how professionals take advantage of this type of behavior, David Pohl shares a sharp observation on how institutional traders seek out predictable stop zones to enter their positions with maximum efficiency.
I'm primarily a trend follower, but I have three rules. The first rule is the good trade is a hard trade. The second rule is that I want to fade the short-term trend against the longer-term trend. Invariably, before the market goes up, especially in the morning, before the market goes up, it goes down first. It goes down to the orders. The professionals would rather die than chase the market. So they will bid it, and they will bid it fairly low. and anybody that panics has got to get out at the bid. So invariably, before the market goes up, it goes down first. Many people believe that there's somebody out to get them, but in fact, that's rubbish. It's just professionals doing their job. And if you're Goldman Sachs and you bid the market and you control a considerable amount of liquidity in the market will go to the orders. The third rule is that I want to put my entries where the masses put their stops. Most people will put their stops at very predictable places. If you're an institutional trader, your job is to generate the liquidity to get into the position. You just can't press the button like us. So invariably, the market makers will not know where the stops are, or they couldn't be bothered to find out. But they know that most people will put their stop a tick or two below the last low. And invariably, the market will go to where the obvious stops are over and over and over again. So rule number 3 is I want to put my entries at the obvious stops. So the next time you're going to put a trade on, and just think, where would I put my stop? And just as you think that, pick something heavy up from your desk and smack it around your head. And rather than putting the order in, put the order in at where you would have put your stop, and just watch how many times the market goes to that.
Paul's insight reinforces how institutional players seek out these obvious zones of liquidity, especially around support and resistance levels, to execute large orders efficiently. By anticipating where most stops are placed, professionals can move the market to those areas and trigger chain reactions in volume. Now let's continue with the explanation. Therefore, we have buy-side liquidity at the top of the phase and sell-side liquidity at the bottom. In essence, these concepts represent the same idea but in opposite directions. Buy-side liquidity refers to areas in the chart where there is a concentration of stop-loss orders, as well as the potential buy-stop orders from long retail traders who operate on breakouts. Sell-side liquidity, conversely, refers to areas in the chart where there is a concentration of stop-loss orders, as well as the potential sell-stop orders from short retail traders who operate on breakouts. Next, we'll examine how the market responds when it encounters these liquidity zones. Suppose the price is moving towards equal highs and retail traders start selling as it nears the resistance, placing their stop losses above it. If the price pushes upward and breaks through the resistance, it triggers the stop losses of those who entered short positions, generating significant buying pressure as these short positions are covered. Additionally, it activates the buy stops of traders entering long positions post-breakout. This combined buying pressure leads to a surge and creates inefficiencies at the top of the structure, potentially encouraging more traders to open long positions in response to the increased market momentum. These scenarios can occur in both accumulation and distribution phases. The only difference is the primary direction the market will follow. Traders should be attentive to these zones to position their orders and stops most effectively, ensuring they can capitalize on the market's movements, whether it proceeds upward or downward. Now we are going to understand how central banks and large financial institutions operate can provide deeper insights. Every time a buy position is executed in the market, there must be someone on the other side willing to sell to fulfill the corresponding buy order and vice versa. Imagine that central banks and large financial institutions are interested in purchasing a significant amount of an asset. To do this, they require a high volume of sell orders. This need arises because without enough sellers in the market, their buy orders can't be executed efficiently. To achieve this, these large players need to create a scenario where there are enough sell orders in the market. One way they do this is by triggering stop-loss orders that retail traders have placed just below support levels. By driving the price down to these stop levels, they can activate a large number of sell orders, creating the liquidity they need. This process involves causing enough market movement to trigger these stop losses, thus creating a pool of sell orders. Similarly, if these institutions need to execute large sell orders, they require a high volume of buy orders. They can trigger these by driving the price up to resistance levels where many retail traders have placed buy stop orders above the resistance. By pushing the price up to these levels, they can create a surge of buy orders, which provides the liquidity needed for their large sell orders. This involves creating a market scenario where the price action reaches the levels that trigger these buy stops. This manipulation creates an illusion among retail traders. They might think they understand the market movements, but in reality the market is being driven to their stop-loss levels by these large players. After triggering these stops and creating the necessary liquidity, the market often resumes its original trend. So, as you can see, understanding how central banks and large financial institutions operate can give you a significant advantage in predicting market movements and placing your orders more strategically. To understand this more clearly, let's consider the scenario where smart money aims to execute a large sell order. As the price moves upward towards the buy-side liquidity, it breaks through the resistance level. This action triggers the stop losses of retail traders who had open short positions near the resistance, causing them to execute buy orders to cover their losses. Simultaneously, it activates the buy stop orders of traders who were looking to buy as the price breaks through the resistance. This influx of buying orders creates a significant amount of liquidity in the market. With this significant influx of buy orders, smart money seizes the opportunity to execute their large sell orders. By doing so, they induce numerous buy orders into the market, which allows them to sell a large volume without causing a significant initial price drop. Once these sell orders are executed, the price enters the markdown phase, pushing downward. This scenario illustrates how smart money capitalizes on buy-side liquidity. They trigger buy-stop orders and stop losses to generate the necessary liquidity for their large sell orders, then use this liquidity to move the market in their favor. A similar concept can be applied to sell-side liquidity, where smart money would trigger sell-stop orders and stop losses below support levels to generate liquidity for their large buy orders. With this theoretical understanding in place, let's move to practical identification using candlestick patterns and chart scenarios. We fully discussed how equal highs and equal lows serve as buy-side and sell-side liquidity. Now we'll focus on swing points as potential buy-side and sell-side liquidity areas. From a candlestick perspective, a candlestick swing low occurs within a 3-candle sequence and represents the lowest low point situated between 2 higher low points in the adjacent candles. So, in this 3-candle sequence, we have a low point with a higher low to its immediate left and another higher low to its immediate right, making this point the proper swing low. Similarly, a candlestick swing high occurs within a 3-candle sequence and represents the highest high point situated between 2 lower high points in the adjacent candles. So what's the theory behind identifying these areas? If someone takes a long position, in this case the first scenario on the green candle area, they are likely to place their stop loss at the recent swing low. Likewise, if they open a short position, in this case, the second scenario on the red candle area, they are likely to place their stop loss at the recent swing high. With this understanding, the resting sell stop orders located below the swing low are referred to as sell-side liquidity. The resting buy stop orders accumulated above the swing high are called buy-side liquidity. It's crucial to identify these zones in our market structure mapping because smart money is always looking to push the price below or above these areas to activate their pending orders in the market. Understanding these dynamics can help traders anticipate potential price movements and make informed trading decisions. By recognizing these patterns and liquidity zones, you can gain a strategic edge in the market, positioning your orders more effectively and improving your chances of success. To see these concepts in action, let's analyze a real chart example. On the screen, we have the euro against the US dollar on the 4-hour time frame. Our goal is to identify the swing points as potential buy-side and sell-side liquidity areas on the chart. Now we are going to identify the swing points as the potential buy-side and sell-side liquidity areas on the chart. Let's begin by identifying the most recent swing points within this bullish rally wave. Can you point out where these swing points are located on the chart? We have a high at the extreme with a lower high on each side of it, so this high represents a swing high, so we have the buy-side liquidity just above the swing high. Similarly, we have a low point with a higher low to its immediate left and another higher low to its immediate right. This low represents a swing low, so we have the sell-side liquidity. If we look precisely, we can see that price has already created another swing point here as we have a low with a higher low to its left and another higher low to its right. So we have another swing low which would be considered sell-side liquidity. In the following, we see that price takes out the most recent sell-side liquidity. As the recent sell-side liquidity is swept, it now moves to this swing low because here we have a low with a higher low on each side of it. Similarly, price swept the buy-side liquidity above the swing high, and now we have a high with a lower high on both sides of it. This represents another buy-side liquidity over there. Let's move on. Here again, we have another swing low that has been swept by the price. A bit higher, we have another swing high that represents another buy-side liquidity near the previous one. The creation of buy-side liquidity close to another buy-side liquidity makes the old one more essential to consider. Again, we see another liquidity sweep right here. As you can see, price has taken below the previous sell-side liquidity and also creates another swing low with this long wick that we consider as another sell-side liquidity resting below the low. Now let's continue. We see that price has entered into a great selling momentum and pushed to the downside and eventually swept the recent sell-side liquidity. If we look closely here, we can detect another swing high right here. As you can see, we have a high with lower highs on its left and right sides, so here we have another buy-side liquidity that needs to be considered. In the following, we see that price pushed lower and also swept the sell-side liquidity resting over here. It is obvious that price forms another swing low, which means we have a newly generated sell-side liquidity beneath the recent swing low. Now let's move forward. Here again, we can detect another swing high as we have a high with a lower high on each side of it, so here we have the buy-side liquidity resting above the swing high. In the following, we see that price pushes to the downside to reach the sell-side liquidity. As you can see, price swept the sell-side liquidity with the wick of this white candle. Then price experienced a bullish pullback toward the buy-side liquidity and also created another buy-side liquidity with this swing high. Let's continue. As you can see, price pushed to the downside and has taken out the sell-side liquidity with this red momentum candle, creating another swing high. Finally, we see the price pushing downwards again, taking out the sell-side liquidity with this red momentum candle. In conclusion, mastering the identification of buy-side and sell-side liquidity is crucial for trading success. Understanding these zones enables you to anticipate market movements and make informed decisions. These areas are where major players influence price actions. Recognizing patterns and manipulation tactics can provide a significant advantage. If you're a day trader or trying to trade like one, you'll want to hear what Howard Marks has to say. His reflection on the loser's game is a wake-up call for anyone trying to win by outsmarting the market at every turn. It connects directly with the mindset behind smart money concepts and why most retail traders lose.
The Loser's Game by Charlie Ellis. This is very interesting. There was a guy named Cy Ramo. He was the R in TRW and very smart. And Cy Ramo wrote a book, and it was about winning at tennis. But what Ramo said is that there are two kinds of winning tennis players. If you look at Pete Sampras or Nadal or Djokovic, how do they win? The winning champion tennis player wins by hitting winning shots. He hits shots that the opponent can't return. They're either so well placed or so strategic or so fast and hard that the opponent can't return them. And if Nadal hits a shot which is not a potential winner, then his opponent can probably put it away because it doesn't have enough difficulty on the ball. So the championship tennis player wins by hitting winners. The amateur tennis player, like him and me, we win not by hitting winners, but by avoiding hitting losers. And we believe that if we can just push it back 20 times and just get it over the net 20 times, our opponent can only do it 19. And we believe that we'll outsteady him, outlast him, and eventually he'll hit it into the net or off the court. We'll win the point. But we'll win the point without having hit a winner. So there are obviously two styles of tennis. And so the same is true for investing. And so Charlie Ellis wrote an article called The Loser's Game. He thought amateur tennis is a loser's game. It's won by the people who avoid being losers. Charlie thinks that investing is a loser's game. And so the best way to win at investing is by not hitting losers. Now, I believe also that it's a loser's game, not as much as Charlie believes, and not for the same reason. Charlie believes that investing is a loser's game because the market is efficient and securities are priced right. I believe there are inefficiencies. I just think it's hard to consistently take advantage of them, and you have to be an exceptional person to take advantage of them on a consistent basis. And the reason that the pro can go for winners is because he is so well schooled and practiced that the ball will go where he wants. He doesn't worry about miscues, wind, sun in his eyes, distraction. He's so well schooled. And in fact, you know, in scoring tennis matches, they keep track of something called unforced errors. And the reason they keep track of them is because there are so few. The pro doesn't make a lot of unforced errors. We make unforced errors all the time. And so we have, in order to survive, we have to avoid them. So the point is, if you're going to be an investor, you have to decide, am I good enough to go for winners, or should I emphasize the avoidance of losers in my approach?
Day trading often feels like a game of constant winners. But as you just saw, surviving the game means avoiding the obvious mistakes. That's exactly what smart money does. It plays the market with precision, not emotion. We hope this video helped you understand the role of liquidity zones. If you want to keep learning, check out our Smart Money Concepts course playlist. We cover topics like market structure, FVGs, liquidity sweeps, breaker blocks, and more. All the links are in the description below. Thank you for your support, and we look forward to seeing you in the next video.
I hope you enjoyed today's video. If you found the content useful or fun, please give it a like, as this helps the video reach more traders like you. Remember to subscribe to the channel and activate notifications to stay updated with the latest financial market information and trading tips. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Your support allows us to continue bringing high-quality content, helping you make more informed decisions in the markets. Thank you for watching, and good luck on achieving excellent results in your trades.